I'm Edith Minette. I'm one of the brokers here at NS Globals, and I cover the luxury asset branch and will be leading the panel today. The webinar is recorded, and so of course, anything that we're discussing is for general information only. I think most of you already know NS, but for those who don't, I'll do a quick intro of what we do and what I do. So NS is a high value finance brokerage. We cover real estate, of course, and we do also security backed lending, corporate finance, and then the luxury asset backed lending. We've been around for about 15 years, and we were founded by Isla Robinson. We formally launched the luxury asset branch about a year ago when I joined. And the initial idea was actually to just focus on art finance, which quickly got out of hand because we had a lot of inquiries for other assets as well, such as yachts, private jets, car finance, and then we do a lot of wine lending and whiskey. We do get some odd requests once in a while. We had a Triceratops skull, which was a funny one. We had some stamp collections. Sometimes we get some jewelry, but so we do get a lot of different assets, but mostly the ones that I mentioned. We work with lots of different lenders. We've got a massive database, which is mostly made of obviously banks, of course, but also private credit. And then we have specialized lenders such as Close Brothers and Artscapey who are joining us today. So we will focus on these assets today and look at trends that we saw in 2025 and what we expect and hope for 2026. We've got lots of questions to guide the session, so thank you for everyone that submitted them. And so before we jump into those questions, I'll invite our panelists to introduce themselves and their companies. And yeah, Thomas, would you like to start?
Thank you, Edith. Thank you for inviting me along, and thank you to Ennis. I'm Thomas Galbraith. I'm co-founder and CEO of Barker. At Barker, we value loan collateral, especially sort of esoteric and hard assets. We then warranty our valuation, and in the event that there's a default and the assets sell for less than we predicted, then we pay the difference. And this has become a pretty powerful tool for lenders within the asset-backed lending space. We're backed by Munich Re, and they are the ones who cut the check in the event that there's a gap. And so we're super excited to be supported by them. And our clients range from bulge bracket banks all the way through to esoteric asset-backed lenders. We've been around since 2022, and excited to call some of the companies on the panel as clients as well.
I think that's a very natural flow or follow-up to Alessandro. Alessandro,
Yeah,
do you want
I'll
to
jump.
explain what
Yeah, makes
Artscape
sense. Well, thanks, Thomas, and obviously thanks, Edith and Dennis, for having me in Artscape in this panel. Very interesting. I'm Alessandro Estasio. I'm the CEO and co-founder of Artscape. What we are fundamentally an digital ecosystem of tools and services for collectors. So, what's our aim is to unlock liquidity in the art market. When we look at liquidity, we usually talk both about equity side, so trading and the buyout, but also the debt side. And we are very much focused on an underserved market, which is the mid market, is underserved both from the top players in the, let me say, trading side, but also on the lending side. Our starting point has been very much understanding the art as an asset class. So we have a robust internal data framework, which provide us with financial signals such as liquidity, volatility on top of the price, plus other 40 odd KPIs. Fundamentally, the most intuitive way to describe us is kind of a neobank, but for art, or if you will, a Revolut for art. So that's what we'll do, I think. So this is us.
Perfect. Which is really exciting. Andrew, do you want to briefly explain what Close Brother does, or specifically what you do actually?
Yes, thank you, Edith. And likewise, thank you for the invitation to speak on the panel today. Very good opportunity for us to share what we do and how we can help the luxury market. So my name is Andy Blundell. I am the Managing Director of Close Brothers Aviation and Marine Finance. My part of the bank is part of the wider Close Brothers group, where Close Brothers is a fully regulated merchant bank headquartered in London. So we're based here, we're regulated by both the FCA and the PRA, and we fully adopt all of their requirements. Close Brothers as a bank has been in operations for about 155 years now. Our history was originally financing railway wagons for the North American gold rushes back in the 19th century. And we've been financing lots of very interesting asset types ever since. The bank itself, on a wider perspective, can finance anything from cars, trucks, buses, plant and equipment, production lines, football players, to what I think is the most exciting bit, which is the aviation and marine finance team, which I lead. I have a team of 10 people. All we do is boats, planes, and helicopters. That can range from a very small, relatively asset for an owner sailor or an owner pilot, all the way up to a large cabin corporate jet, or maybe a 60-meter yacht in the Mediterranean, and pretty much everything in between.
Yeah, which is really exciting for us. So I think it's a good introduction, good overview of what everyone does. There's a lot of overlaps between the three companies, or the four, I should say, including Ennis. I think we'll dive straight into it with the first question to Thomas, as you really oversee all the different asset classes with the AI tool that you have. So since you value everything from art to yachts, which asset class do you think in 2025 has surprised you the most, in terms of just complexity or market? Sorry, that maybe threw you off.
No. It's a good question, because you kind of have to think through market movements and how they change from asset to asset and sector to sector. As you kind of touched on, just sort of to provide a foundation. So we built our own domain-specific LLM. So we have our own AI that values assets. And in order to do that, we have to scrape huge volumes of data across different segments for different assets and different transactions. And I think one of the things, there's probably two things that stand out to me, but one of the things that really stood out to us last year was the fact that GPU pricing, we price GPUs and we underwrite that value as well, has been really, really difficult for a lot of companies and a lot of investors. And you see these arguments on LinkedIn, or you see them in the press, where people are saying, well, GPUs should be depreciated at the same rate as general equipment, whether it's farm equipment or commercial equipment or whatever it might be. And they have no real life or no real use after 3 to 5 years or something along those lines. And then we just don't see that. Like we're seeing value being held by those assets for well beyond 5 years, 10 years even. There's some assets that are still in use that Google developed 10 years ago. They still have value to them. So I think that's one of the things that really jumps out to us as in need of a greater degree of accuracy and understanding, is that once you can look at an asset from a data-driven perspective, you can start to appreciate market trends, and also it's the value that it can retain over a long period of time. So that GPUs is definitely one thing that we saw. And then the second thing, at the total other end of the spectrum, so artworks, for example, we also value artworks. And there we saw something interesting, which was the market has seen a significant drop from the peaks of 2022, for example. And the drop has been pretty consistent and pretty steady since 2022. It's just been dropping roughly 30% per annum. Like it's not pretty. And that was super interesting on our end, partly because obviously we have to account for the market movements. We have to account for changes in valuations, but also because of the impact on what we see with our lender clients, right? Like a lot of lender clients have seen a pretty significant uptick in loan requests
Mm.
because clients don't want to sell when the market's down.
No, exactly. We see a lot
They would, yeah, exactly. Like why lock in your losses? Why not just borrow against the assets for a short period of time,
Yeah, exactly. And
whatever
sell
that period. Yeah, it's much better. And then you have optionality at the end of the cycle. You pay the loan back, you still own the asset, and you can still participate in the upside later. So I would say those are the two biggest sort of trends that we've seen in 2025, at least in our business, and the impact that they've had on our clients.
One question that we've already discussed, but I think would be interesting for the audience, for you, Thomas, again, is obviously how, well, we touched upon the art market, but in an opaque market, typically like the art market, how do you deal with
They're all so opaque.
Yeah, but exactly. So these private sales, for instance, how do you build a model where you don't have access, where you have limited access to the data?
Yeah, so
Sorry,
we
that's also a
scrape.
tricky question for you.
No, all good, all good. We scrape huge amounts of data, content, transactional data on the assets that we value publicly on the internet, right? That's relatively straightforward. Most valuation firms do that.
Mm-hmm.
We then also require that our lender clients share asset-related data with us, and it's in the contract. It has to be all asset-related data. So that includes invoices, third-party appraisals, if it's an artwork, then potentially a private sale letter or something along those lines. So then we're also gathering huge volumes of private data as well, and then we incorporate that into our data set. So we're building out a public data set and a private data set.
Yeah.
And lenders are incentivized to do that, to share that information with us, because using our product, invariably they benefit by increasing their profit margin. So there's a real tangible impact to their business if they participate in this program with us.
Yeah.
So we are building out a significant data set, a significant proprietary data set that enables us to price assets with a much higher degree of accuracy.
Yeah. It makes sense. Andrew, I'll jump onto you now. Kind of bouncing off what Thomas just said. With have these advances in valuation technology, have they changed internal decision making or risk assessment?
So that's a great question, but it probably differs by asset class.
Yeah.
So clearly, the more valuation data that we can get as a lender, then that's better for us, because we really need to understand not only what it's worth now, but perhaps historically when the market's been in a down cycle or a real up cycle, what that looks as well, so we can help to understand where we really are within that cycle and judge our lending against it. If we look at aircraft, so fixed wing and helicopters, generally, although not always, generally they are easier to value, because there is a direct correlation between usage, hours flown, time to overhaul, to market value, regardless of where we are in the cycle, and also what sort of maintenance programs those assets are signed up to. Excuse me. The yachts, on the other hand, can be very different. So if you have a production yacht, generally sort of 30 meters and below, sometimes a bit higher, they are broadly very similar from each yard. So yard number 1, 2, 3, 4 will all be fairly similar. Once you get into semi-custom and custom above that sort of size, even if you have 2 consecutive yard numbers, they could be very, very different internally, even if they don't look too dissimilar outside. So that's where we really rely on specialist valuers and surveyors to help us not only understand the condition of the asset that we're looking at, but also where it fits within the overall general market, what what types and sizes of yachts are selling well, what doesn't, what yards are more favoured and carry a premium compared to those that are perhaps newer entrant and haven't quite hit their market level yet. So there's a lot more just because yachts are so different.
Yeah. But so Annie, you've been in the industry for a while. I think you've been with Close Brothers for about 10 years, and then before that, remind me.
I was with Royal Bank of Scotland for 17 years before that, and
Exactly.
Barclays before that. So
yes, so
yeah.
you know the market pretty well.
Yeah.
So I thought I'd ask you what lessons from previous market cycles do you think are relevant today?
So bankers do notoriously have quite long memories, which is good, so we always perhaps always remember the bad times a bit more than the good times, but but things always buy and sell, which is which is good. I've never seen, even when I was a junior back in Barclays in the late 1980s, there were still deals being done. So it's not as if things are always ground to a halt. There's always the concept of the willing buyer, willing seller, and maybe the less willing buyer and the must seller, but deals always get done. So it's really understanding not only what the value of your asset is today, but what's really important for a lender is if you do have to become the proud owner of a vessel or an aircraft, how you as a lender are going to get out of it. Now, traditionally, that's knowing the market really well, understanding where you are, what your hold costs are going to be, so you can look at the whole life cost of holding, maintaining, repairing, and exiting an asset. But also now, which is really interesting with what Thomas has got, is having maybe that extra protection on board as well. And also remembering to pay the electric bill for the lights. So we have there's a cycles repeat themselves. It's trying to understand what the real value of your asset's going to be throughout that point, and also picking your customers and your clients for the long term, because you want to have a relationship with them so that they enjoy either the use of their asset or get real commercial benefit from it, and you hope they come back.
Yeah. Talking about clients, Alessandro, I'll start by asking you if you've seen any, so in your database of clients, have you seen any generational difference in how collectors approach valuation and, well, transparency and financing? Yeah.
Yeah, so I think that's a broader question on the asset class specific, right? So art, as most of these other passion assets, is this intersection of luxury, wealth, and passion, as I said. So there is not only a generational difference, but there is an underlying reality, especially in that market. Not two collectors are alike. So they do not buy the same things, they do not buy the same artists, and the reason to buy is even more broad and inconsistent, I'd say. The overall approach, like when we launched Arscape, our assumption was that we would have had a higher uptake from a younger generation of collectors. So let me say 45 and below.
Yeah.
Reality is that the most hardcore users, the one that are actually using the more, is the slightly older generation.
Oh, really?
However, yes.
I would have actually had the same assumption as you had.
Absolutely. And then when it goes into the Arscape depth of and range of services probably. But when we then look at a transaction, so either into the trading or as a securitized lending, there is an absolute shift. So younger generation is definitely more aware of data pointer, where and which data to look for, even though they may not have a formal understanding or a full understanding of the actual market value. For sure, they are more data savvy than a previous generation. So that's the first part. The second part is the idea of leveraging a collection is fairly still new. It's nothing new as an industry term, obviously, but it's very new in the market we are, which is the mid market.
Yeah.
So we are in a market that, as I said earlier, is absolutely underserved because usually you're a typical accel lender, institutional or not, they tend to want to do big deployments on and single asset value above, let me say, starting at early seven figures, while below the threshold, usually you find more of the luxury pawnbroking and not many specialty lenders. So having brought this opportunity to collectors in this segment is still something that require an educational piece, but it's incredible how much curiosity there is and how many requests we're getting from clients that they really want to understand how to leverage their collection. So anyway, consider that mid-market as for the value of the single asset, but as a total asset value can also be in the multi-million. So
Yeah.
sometimes you collect a lot with 50, 70, 100 properties, and then they can actually not get access to a credit line or to a leverage because of the value of the asset, which probably is be funny for that with Thomas. We did an underwriting just before Christmas. So this
I was just going to ask about it.
yeah, like because this gives you the idea on how collectors are also seeing the opportunity. So this client was an Arscapi client for other kind of services as an advisor. Our advisory branch was servicing him. He did a few transactions with us, but then at some point when we started to make people aware of our product, he asked if he could have access. So perfect life cycle. So a person that is enriching his collection, all the artworks we were valuing were within our thesis, so liquid, up to six, early seven figures. And then so it's been just a perfect example on how people are working together. And the reason why it was accessing to securitized lending is to keep expanding the collection. So from a operational point of view, I think what is interesting is you get a client end to end. Working with Thomas and Barker's team is also super useful from a lender point of view because comparing notes on value. I mean, Thomas, you already said that obviously you require your client to share notes, but anyway, it's an extremely useful exercise because also we have our model and then together we can adjust risk and offer a very compelling term sheet to client.
It's actually really funny because I actually invited both of you to the panel without knowing that you guys work together. So I'm glad that clearly I wasn't the only one seeing the crossover.
That's funny.
So
Yeah, I mean, from our perspective, it's interesting to be able to provide exactly what Alessandro was hinting at, which is this independent data-driven valuation, which doesn't mean to say that other companies aren't also using data to inform their valuations as well. Of course they are. But I think having multiple different models available to you is only going to help the underwriting process, right? I think if I might ruffle some feathers, but there's a lot of AI crap out there. There's a lot of companies that
everything.
they say they're AI or like I don't know, the note takers that join video calls and things like that. Like they're not actually really adding value. And I think we're in the early stages of where AI can add value at an enterprise level. And this is a very real example of where it can, right? Like we've coupled that with the fact that we underwrite that price as well. So the two together provide a pretty powerful product. But to Alessandro's point, having that external reference that is data driven, that is based on AI, based on machine learning, to give you a little bit of a gut check, it really can
It builds
dramatically
confidence.
change.
Yes.
Yeah, changes the way you approach the underwriting process.
Yes. And
And sorry, I'm
no,
sorry.
yeah, no, so just to build on this, like I think what's becoming even the next stage of defining the pricing is not only down protecting, like working with a company like Barker, is also from a lender point of view, understanding what's the liquidity. So that's for us then fundamentally the full point. Like probably Andrew said earlier, what's the willingness to buy, what's the price? That's how deep the liquidity can be. And the understanding the liquidity profile in that market is I think is a paramount at the same level of defining the price, because almost one is the function of the other. So that's
Yeah, I think that's a good point, because there's also multiple examples of recently asset-backed loans blowing up because the valuation was just wildly wrong. And sometimes that's because someone was doing it on purpose, and also sometimes it's just because nobody knew. Like nobody, like it was just a stab in the dark. There was a valuation that was thrown out, and I want to say it was Apollo most recently was in the news about that, but
yeah.
not for good reasons. But ultimately, the evaluation was just wildly inaccurate.
I mean, we get
Uh,
most of the inquiries that we get are actually overvalued, I would say. And then, when you run them, well, through a revaluation for a lending purpose, suddenly the numbers are much lower. And this is not necessarily even with AI, it's just in general.
Exactly. Yeah.
And so,
It's
you're
the
saying
single
AI is,
biggest liability in asset-backed lending underwriting is the value of the asset that you're
yeah.
lending against. Like,
But so I'd like to ask you then, Thomas, where do you think traditional valuers would still clearly outperform AI today, and vice versa? Where do you think AI undeniably wins?
um, I mean, uh, I'll start by saying that we
AI
encourage our
wins.
clients to continue to use whatever valuation firm they currently use, right? And partly that's because if you're a bank, especially in the US, you're supposed to be using an appraiser that's USPAP certified. While our AI is trained on USPAP, which is an appraisal certification here in the US.
Yeah.
Technically, by nature of the fact that it's AI and not a human, it is not USPAP certified. So that's one caveat, is we do encourage people to continue to use appraisers. The biggest difference, I think, comes down to the ability to ingest and understand just a gargantuan amount of data. And a human appraiser can't be expected to do that. So if you're dealing with more homogeneous assets, if you're dealing with assets where there's a larger bucket of data sets that you can draw on, or if you're concerned about macroeconomic inputs in addition to specific market inputs. Our AI, as far as we can see, and we test it against multiple different models, it is phenomenally accurate. We're talking about like a 5 to 10% margin of error, depending upon the asset,
Which is actually nothing
compared
to the
to
other.
which is nothing, like compared to a human appraiser, where you might see 50 to 100% margin of error. Like a lot of auction houses will give you an estimate and say, we think this is worth 100 to 200,000 pounds, and you're like, that's a massive margin of error. Like you could be wrong like so much in that space. So I think I would say that's the biggest advantage, is that we can be highly accurate when there's sufficient data. Now, to your question of like when might a human appraiser be more accurate, I think that's when you have to start dialing in on assets for which there is almost no comparable, right? Like
Like a tricycle.
yeah, I mean, like something which is a one of one, but like just totally I don't know, it'd be like selling the pyramids or something insane.
Buying
Um,
Buckingham Palace.
yeah, for which there is no real comparable. Now that doesn't mean to say that we couldn't potentially price an asset like that. I think we could, but there is a degree of creative input that I think a human appraiser might be able to impart that a data-driven AI result might struggle with.
Mm.
And we're very upfront about that. Like if someone sends in an asset that we feel like we can't price or that we're not going to be as accurate as we would like to be, then we tell the lender, we say, look, we're not the people for this. We can't help you. The last point I will make before I shut up is
I have more questions for you right away.
we don't give our AI price unfiltered to our clients.
No.
So the AI ingests the data, it outputs a price, and then it's checked by a human on the team. So we have USPAP certified individuals on the team, appraisers on the team who check the output to make sure that there's no hallucination or there's nothing crazy going on. And we're pricing assets on a bell curve as well. So before it gets to the point of being sent to the client, we are doing that human review. So I do still think that like AI is additive, but it's not at the point yet where it's necessarily replacing us.
Yeah. So we've spoken a lot about AI in art. Andrew, I thought I'd ask you to compare to this pretty fragile art market, or at least how it has been for the past few years. What has been the sentiment amongst owners of yacht and private aircraft compared to the art market? Is it more confident, do you think? Is it more cautious or pragmatic? I mean, the macroeconomics is a bit all over the place at the moment, so I have an idea of what you're going to answer, but I'd be interested for your insight.
Sure. So again, there's probably two distinct points there. As I said, there are lots of deals happening, whether they're paid for cash, whether they're funded via general corporate resources or via lenders such as ourselves. So there are still a lot of transactions going on in the market. The deals that happen quickly are the ones where there's realistic pricing on both sides. Certainly, just over a year ago, there was still, I think, a mismatch because there was a lot of owners that thought because they bought immediately post-COVID, when the market was very frothy, that they could still command those sorts of prices. Whereas the potential buyers were realizing that actually transactions were taking longer. They could afford to wait, because if you went back, say 3 odd years ago, if you didn't buy it now, sometimes even without doing the normal type of survey, then it might be gone to somebody else. That's not happened, so that they were all almost willing to miss one and get the next one. So there's definitely a longer cycle generally between listing and purchase. There is some price negotiation undoubtedly, but the more realistic you are from the outset, is the quicker that deal will happen. On aircraft, there is a slightly different dynamic because they are genuinely seen as more business assets. So the imperative to actually have secure, quick, confidential transportation, or point-to-point transportation, where some of the islands either can't or just haven't gone back to, that still does drive some good demand, be it charter or be it for actual ownership as well. The other interesting thing is that although market demand may have softened, prices have gone up just because of general inflationary and supply chain issues. So everything is more expensive. So a brand new aircraft or yacht is a lot more expensive than it would have been 3 or 4 years ago, which does drag up the prices of the pre-owned inventory. So the cost between the two isn't necessarily widening. It's just all a bit more expensive than it used to be.
And has that impacted the financing as well then?
It means we can lend more money, which is great.
Buy less. Yeah. Sorry?
It means we can lend more money because they're more expensive generally. So we find it's quite hard to predict either which month or which quarter deals will happen, because there is a general longer time frame, generally outside of our control, but either surveys work need being doing, or there might be extra additional works done, or something's not just quite ready, and buyers are generally in less of a rush. So most of our private side clients, they still have businesses, investments and things, so
Yeah.
that will naturally take up most of their interest, because that's how they're generating their revenues, and they will come to our bit whenever there's some spare time, if you like. It's not always the most important thing on their desk.
No.
So they can tend to drag. But going back to what I said earlier about understanding your market and your valuations, you're still going to go in at the relevant price point, which may have gone up, as long as the asset's been looked after, maintained properly, and it's not one of one, as they were saying in the previous discussion, because it might be one of one because it's the best. It might be one of one because nobody else wants one. So you need to understand exactly where it is in the market.
Yeah. One comment that we often get at Ennis, well, being an overall high value finance brokerage, is people always ask, why do high net worth clients need to borrow? People just assume that, if you have cash, you can't afford a yacht. So that's a question for you. Why do you think these type of clients borrow, even if they don't technically need to?
Well, they don't need to. And to be honest, if someone approached us needing to borrow against a new 50-meter yacht purchase, we would probably not want to do it. They borrowed because they choose to, as part of their overall liquidity mix.
Yep.
So the value of the yacht is, yes, it's the it's the metal, it's the asset, it's the enjoyment you get, but it's more than just the money. What ultra high net worth and family offices like is having liquidity, especially at the moment, because there are lots of opportunities out there in the general world. So there is no point, we would argue, in tying up 5, 10, 20, 50 million in a generally depreciating asset, when if you finance some of it with some modest leverage, you can put that money to work and earn more money on the money. And also there is a premium for liquidity. So if the funds are readily deployable for an opportunity, if you move faster, you can generally get a better price for it if someone is stressed. So there is a combination of all those factors. So it's a desire to borrow as part of their overall wealth mix rather than having to.
Yep.
Yeah, I see the same thing with our clients. Like, that's typically the reasoning. Or working capital is another one. If it's a business, then to Andy's point, like locking up 10, 20 million is just not capital efficient.
Yep.
That's largely the reason why people are doing it.
Alessandra, do you think, coming back to the art market, and if it's softened now in 2026, which it seems to be recovering a little bit, do you think that will strengthen or weaken the case for art-backed lending?
I'll say a couple of things. So the first is a statement. I'm fairly confident that the worst is on the back. This is not anecdotally, but again, is a more a data-led assumption that I'm making here. And at least, again, we focus very much on a specific segment. And on this, I'm not only confident, I'm quite bullish. Anyway, I think here there is a body narrative that we want to bring it up, right? So Thomas already said earlier, why would you sell if you are actually booking a loss on your asset? I'd rather leveraging it. Reality is that this goes also on the way around. So in a bullish market, why would you sell if you can leverage the asset to do another acquisition and you fundamentally offset the cost of capital with increasing value of the asset itself? So I think that asset-backed lending is in line of principle transparent to market cycles. So it should be almost influential. What I think change is the reason to borrow and the opportunities that clients see with having or locking liquidity in the asset or in the market. So I think that's the my view, to be honest, and this is also the way that you're seeing. I mean, like, sorry if I echo again, Thomas, and like our clients do not actually need to borrow money, but they are seeing opportunities on the market, and this is just part of a wealth mix. So I think for us, the next phase is bringing art lending into a much bigger crowd of people to in front of way more clients that are almost unaware they can pursue other opportunities while not accessing their collections, because again, we are still talking about a mix of investment, passion, and cultural, so it's quite of a complex asset.
Yeah.
Um,
We do have a lot of clients here that, they come here, well, they come to Ennis because they need a mortgage. We've done a mortgage with them. And then they come back because they need some more financing. And we tell them, oh, actually, we also do asset-backed lending. And they've never really thought about it or even knew that it existed. And then, you give them some indicative terms and suddenly it's helping them with another project, which they wouldn't have thought about before. Is that something that you see with clients as well? Because obviously Artscapy is a platform with lots of different services. Do you feel like the clients see that full picture and really see how interconnected all these different services are?
Yes, but Artscapy we have such a big offering. So like, let me tell you the biggest in the world I want. That client can stumble upon us for one specific need, and then as I brought the case of the previous client, then they get hooked within the full ecosystem. So like, just to give you an actual number, right? So we offer fundamentally 8 paid service. On average, a client uses 3.5 service in Artscapy per year. So there is value in the ecosystem, there is value in the education, and there is value in coming forward with the idea of transparency and fiduciary duties that I know that for Andrew is the daily job, but in the art industry it's not necessary what it's famous for. So these are kind of values that are financial level, financial grade, but brought it into industry where it doesn't adhere necessarily to this kind of code of conduct. So yes, so like what we are seeing, and this is something also Thomas probably will echo, is a more interest also from institutionals. So we are now onboarding a private bank, and I think 7 billion, something like this, family office as a white label service of Artscapy. So they're going to start to use part of our technology for some part of the underwriting and so on and so forth. So that these are trends that are unheard before. So still nowadays, most of the financial institutions are like, no, we don't want to jump into this segment of the market. It's too risky. But what is risky is risky, as we said, the pricing, understanding the asset. Once that becomes an objective exercise with some subjective adjustment, I think you have an incredible opportunity.
Have you found, well, remind me when you launched again the AI tool again?
We launched in publicly in November. So we've been using AI since the very early models of OpenAI, but they were for internal valuations. So I think that still at today we are the only first and only company in the world offering an instant AI estimate appraisal to any clients who want to try it fundamentally. Yeah.
So, Thomas, you're next. Do you then think, just on what Alessandro was saying, do you think that AI valuation will, not necessarily in 2026, but do you think it will become a requirement in the future for lenders, rather than just an enhancement? Sort of a bold statement, but
There's nothing wrong with the bold statement. I'm not sure if it's going to become a requirement. Um, maybe eventually some form of requirement, or it will replace existing requirements in some capacity, or valuation requirements will shift to account for it. Anyone in banking can probably speak to this. Like regulatory and banking requirements take decades.
And they
They're agreed upon 20 years ago, then they're implemented 20 years later.
Mm.
And then there's unintended consequences when they do, right? So I think what we're probably going to see, at least from what we see on our end, is first of all, there's a recognition of the value, right? And this is just speaking from Barker's perspective. Clients understand, like, yes, it's important to get an independent valuation. It just so happens that we use AI, right? And then that valuation is underwritten, which helps them transfer risk off balance sheet, or valuation risk off balance sheet. So all of those things, they recognize the value of that. And I think that it's value that typically drives adoption, right? If I kind of did a whole song and dance being like, oh, like we're really good at valuing things. So is everyone, like, so is like a lot of other firms, right? Like there isn't really any major reason to use our product. The biggest reason to use our product is the fact that we actually promise that we're accurate, which is our biggest differentiator. So in terms of whether AI-based valuations in of themselves, I think, will become a requirement. I I don't think that will happen, or I should say, I don't think there's a major incentive to make that happen. But I do think there's a major incentive to implement risk mitigation opportunities, right? Like in again, speaking to the bankers in the world, like the CYA policies, right? Anything you can do to cover your ass, you should be implementing it. And when you go down that road, then you can see that actually having like AI-based, highly accurate valuations is beneficial, especially if they come with some kind of risk transfer. So I think it's less coming from a regulatory demand. It's more like best practices will encourage banks and lenders to do this themselves anyway.
I'm seeing here, we've got 10 minutes left, and I've got a few questions from the audience. So I thought we bounce on that. One is still on AI, so I think, Thomas, this is still for you. I saw that you've answered a few already. But so this is someone asking if jewelry could also reliably be valued by AI. And I think it's a really interesting question because we get a lot of jewelry, and a lot of it is completely overvalued, but way more than any other asset class. So my personal opinion is that I think AI valuation would probably save jewelry valuation, at least from a lending perspective. But Thomas, I don't know what your thoughts are.
Yeah, we do it already, and we have clients who use it.
Yeah.
I will caveat that by saying that we don't do things like uncut stones.
Billion
We
dollar
don't do like, yeah, exactly.
I think we
But
all
we,
get on a regular basis uncut stones worth billions with no
yeah,
certificates attached.
exactly. So yes, the short answer is yes, we do. We can do it. We do it. We already do it. We do jewelry. We do diamonds. We do like a whole range of assets in that class.
Then we have another question for Alessandro, which I also thought was actually quite interesting. It says, do clients have to confirm that the artwork is subject to any bailment claims or disputes? Which is a really great question, obviously, since if you use it as a collateral, you obviously want to avoid having double claims or any dispute related that you're not aware of. In the US, you have a public register where
Yes.
all of that is recorded, but we don't have that in Europe, which is Terrible in my opinion. I really wish we had that. I think it would make a lot of different actors in the industry's lives much easier. But yeah, Alessandro, I don't know if you want to answer that. I think it's
Yeah, so I think you brought up the first point, which is a multi regulatory issue here, right? So the straight answer is we check depending upon where the asset is, if it's under any special condition, bailment, there is anything written on a public registry. US is fairly straightforward with the USGC. Europe is slightly more tricky, but overall we mitigate these by taking possession of the security. So it's a possessive underwriting. So that's at least in Europe, yeah, helps to reduce this kind of risks. So yeah, so and then building on the requirement of the client, if is a loan with a sale objective, then we enter into the agreement with an eventual appointed representative for the sale, so with the sale agent, anyway, which usually become Artscape itself. So as I said, the other side of Artscape is also an incredible efficient trading platform, which, by the way, de-risk our exposure quite a bit. So fundamentally, a default, I would say 9.9 out of 10 should be liquidated in a very short time through Artscape already. So that's let me say, is a more B2B USP we have for our credit provider. So it's obviously transparent for clients or else on the market. But yeah, so that's part of our process. So
I think a lot of things that clients don't realize, well, what I find is that what they don't realize when it comes to loans is that obviously if you use the asset as a collateral, and that counts mostly for assets that are not yachts and aircrafts, but for anything else really, it has to be in the possession of the lender. And this is obviously because it's a very risky type of finance where you can't just take
Depends on the geography.
yeah,
exactly. I go back to the US is a definitely more mature.
apart from the US,
yeah.
apart from the US. But maybe
And sometimes it depends on the client. Like
Exactly.
some private banks will bend over backwards to help some private clients keep assets on their wall. And
Yes, but they
they'll
don't
they'll
take
get creative with it.
only the art, right? So
they don't have
This
the
is true.
passive
They do
AUM.
recourse lending. Yeah,
exactly.
exactly.
So
Yeah.
Yeah, I
better
think
position to be.
I think most of the time, I'll rephrase, most of the time, clients will have to move their asset, that is, most of the time in Europe, will have to move their asset into the possession of the lender. And there are obviously exceptions, but the exception will then have to be really analyzed properly. I mean, for yachts, what we have and what I find quite difficult is, in general, obviously, the yacht can be anywhere, or at least can be agreed to go to the Caribbean, for instance. What we have a lot is clients from the UAE that want to have their yacht there. And I don't think I'm still yet to find a lender that is comfortable with that. I don't think any lender would be. Again, this is just in case there's a default, how do you do to retrieve the collateral? Andrew, and that's a problem that we've had in the past. I don't know if you have a comment on that.
So I think the commentary I'd give is that it's still a relatively new area in banking sort of terms, especially in terms of default, repossession, and sale, and because there's not an obvious case history of successful repossessions and claims, it naturally makes bankers very nervous, regardless of any geopolitical, physical harm that may come to the assets, given wider world events at the moment. So whilst in theory it may be possible to enforce, repossess, sell, in practice it's very rarely been done. Yeah, it can. But there are again, there are theoretical ways around it. I think a local lender would be more willing to accept the local legal environment where you can do so. But what they probably haven't got is the expertise in lending against yachts. So
Exactly.
there is a mismatch between the two. And
Yeah.
I think that's the main problem. I think one thing that we certainly see is that that because the world is ever more regulated, which is is generally a good thing. A lot of non-international banks have a less far-reaching reach because it's just getting too complex to do it. So if you're a major international wealth bank, you may have representation in 20 countries, therefore it's easier for you. But again, they will only finance things starting at probably 15 or 20 million.
Yeah.
So there is,
We've got 4 minutes left. I think I'll finish on this question for you, Andy. It's a bit more light than the rest. So
Like,
it goes off.
you might.
That's the end for Andy. No, but so I would be curious to hear what would genuinely surprise you in 2026.
I would be surprised if the market stayed the same as it is now, whether it's
Okay.
up, down, different. I think, for example, the hype of the new aviation, the eVTOLs and things has probably gone away.
Mm.
But if there is a genuine launch in that market, I think that has the potential to be very interesting. Although I think the regulatory environment they would have to work in will probably prohibit that a little bit, but you never know. I think there's an interesting political development in terms of sanctions. In terms of a lot of luxury assets are currently tied up, whether they become available for recirculation, whether they are reclaimed, whether anybody wants them because they won't have been maintained as required over the next 12 months. That I think that will be very interesting. But I think something that will surprise me will be something I haven't thought of yet.
Yeah.
That's what I
Thomas,
say.
Alessandro, do you have anything that would surprise you?
surprise. Well,
Sorry?
say it again. So it's surprising. Is anything
Yeah,
surprising?
what would genuinely surprise you in 2026?
So I don't know, like more than surprise. I think the opportunities of bringing a lending product that are scalable is something that is gonna start. I think probably last year, but it's starting really this year, and I think. I'd be surprised to see still a crunch in the market. So that would be quite unseen. So I think let's say savvy collector see that the window for great acquisition is closing, and because a lot of people have been keeping liquidity ready in the last couple of years for the whole geopolitical reasons we already discussed. I think that they are starting to deploy, and then now when I look at our clients again, the mid market. It's not necessarily the big checks, but are still is an incredible amount of liquidity that is ready to go and is coming. Beside the other trend, which is slightly less happy, which is probate
Let's end on a happy note, but
no, yeah, but it's a wealth transfer, so that's another gigantic thing that's coming our way from collectors. So with a few cases of a very important collection coming, say, okay, how can the accession it, or how can I leverage it? So it's these are macro trend that require and needs to be served, and I think. The beautiful things of technology is unlocking scale, and I think that AI is the tip of the iceberg when it comes to pricing, because scale is the throughout the whole underwriting process. So that's
okay. Well, I think overall we had a lot of very positive notes, despite living in a crazy world. Thank you all for joining today. I found the discussion very interesting. We'll have so we have a few questions, I think, in the box here that we will answer by email. If there are any other questions from anyone listening to this, please let us know, and we'll just dump all of that in an email in the coming days. So thank you very much, and until next
Thank
time.
you, Edith.
Thank you.
Thank you.
Thank
Bye-bye.
you so much.
Bye. Bye-bye.
Bye.
Cheers.
Bye.
Cheers.
Bye, guys.
Bye-bye.